Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Saturday. It is February the 5th. It is about 9 p.m. And I thought what we could do is take a little bit of time to talk about drips. And by that, I don't mean old fossils like me. In other words, your proverbial drip coming at you live from Palm Beach. I'm talking about dividend reinvestment programs, DRIP. So if you're an old pro and you don't need any education at all, then this video is not for you. But otherwise, if you would like a refresher, or if you have a bit of time and you just want to listen to what Mr. Oxy has to say about drips, then now is the time to spend a few minutes with me and listen to what I have to share about drips. A drip is a program that allows investors to reinvest into additional or fractional shares of an underlying stock. So what I'm going to do in this video is use as an example Sibanye-Stillwater. So what you have here is a ADR for me. ADR means an American Depository Receipt, because this is a company that is not headquartered in the United States, but I can buy SBSW, Sibanye-Stillwater, trading on the New York Stock Exchange as SBSW, as an ADR in the United States. I picked this one because it pays dividend of about 10%. Now, the first thing that you got to notice here is that the dividend is not actually 11% or 10.99. It is actually $1.65. It just so happens that $1.65 compared to the current or last closing price of $15 calculates mathematically to 10.99%. So if someone says this one pays a dividend of 10 or 11%, that is not strictly true. It pays a dividend of $1.65 on an annual basis. And right now, that is just calculating as a percentage of the actual closing price of the shares at 10.99%. So the dividend yield, so that you know, is actually the dollar value simply expressed as a percentage. So let's look at this one in just a little bit more detail. We're talking about $1.65, and that is basically fixed. At $15, it yields approximately 11%. If we look at the 52-week range, the low was $11.15. Then if you earn $1.65, the dividend yield would be 15%. Or comparatively, if you purchased Sibanye at the 52-week high price of $20.68, then the dividend yield is only 8%, right? So the dividend is actually $1.65, and the percentage is simply based on the closing price of the stock at any particular point in time. Assuming the $1.65 dividend is maintained, the annual dividend percentage yield, therefore, is based on your average cost basis. This is important for you to keep in mind. Let's take a look at that in just a little bit more detail, taking some eloquent text as opposed to my second language attempt here. Annual dividend is calculated by multiplying the announced next regular dividend amount times the annual payment frequency. If no dividend has been announced, no new dividend has been announced, the most recent dividend is used, which is $1.65 in my example. If dividend payments are inconsistent, as it is with many ADRs, American Depository Receipts, the annual dividend is calculated by totaling the regular dividends paid over the trailing 12 months. In other words, Sibanye paid $1.65 over the TTM, which is the trailing 12 months, and therefore its dividend currently, based on a $15 stock price, is approximately 10.99 or otherwise 11%. Dividend yield calculations do not guarantee or imply future payment of dividends because we don't know what will happen in the future. Why do we do this at all? Well, dividends are a convenient way to grow your positions if you enroll in a dividend reinvestment plan, which is a DRIP. It's a convenient way to grow your positions because you are automatically reinvesting dividends from stocks and ETFs to purchase more stocks, in other words, whole or fractional shares. So every time Sibanye pays a dividend of whatever the dollar amount is, so if it's $1.65 per share on an annualized basis, and you have 100 shares, it's paying you $1.65 times 100 shares, with which you can use more, which you can use the cash for to buy more shares. Now, of course, from a tax point of view, dividends is income. So unless you have it sheltered in IRA, which is a retirement type account, you would be liable to pay taxes on that too. So here's an income estimator, and I'm sharing this with you because MTC is my charitable foundation, Memory Trees Corporation, and this is a real account, and this is showing you the estimated income pay dates, in other words, when the dividends will be paid, and it shows you that on this particular account, Memory Trees Corporation, which is a charitable foundation, will be earning approximately $7,200 per year, or an average of about $600 per month. How does it achieve that? Well, this particular account only has 4 investments, and they are respectively ICANN, which pays almost 15% based on its current yield of $2 per share, AG&C, which is a REIT, it pays 12 cents per share, Alliance Bernstein, which is a financial services company, and Energy Transfer. So you get where I'm going. This shows you the income estimator based on dividends only for the next year. In other words, looking ahead to 2022. So you can view the dividend yield, in this case, $7,200, as a hedge for a potential market pullback. Of course, if the stock prices of the shares, the 4 shares or equities that we are invested in here, were to go up over the next year, then that gain would be in addition to the estimated annual income achieved from the dividend program, which is reinvested to buy more stock. Now, there's an easy and simple calculator that you can use. It's actually a really neat little tool. You can go to tipranks.com and look up the calculator on DRIP's dividend reinvestment programs. And all you have to do is fill in the blanks, and it will show you, for example, what your portfolio will look like after 10 years. So using my example of Sibanye, remember we said the share price, the closing share price on Friday was $15 per share. And let's say I want to buy 100 shares of Sibanye, which is going to be an investment amount of $1,500, and I'm prepared to hold this position for 10 years. And I'm expecting an annual dividend yield of 10%, which is actually somewhat conservative because it currently pays about 11% based on the stock price of $15. Then if you click the little blue button that says calculate my returns, right at the bottom of the screen here, it will show you that if you make this investment, which as I said is $1,500, after a 10-year period, you would have approximately $4,000, which is more than 2x, for a total return of 168% over that period. Now, you will notice that I left many of the fields blank over here. So if we go one step deeper and we use the same example, and we say Sibanye's closing price on Friday was $15, I bought 100 shares, that's $1,500. I'm going to hold this for 10 years. I'm expecting an annual dividend yield of 10%. The dividends are paid quarterly. Sibanye is actually paid twice a year. And then I'm going to make an annual contribution of only $120 per year, right? So in other words, I'm investing an additional $10 per month in Sibanye stock. And I have a dividend tax rate of 20%, which is an assumed number because I have absolutely no idea what your effective tax rate is. And I'm expecting the annual share price to increase by approximately 5% per year. So you see how you can play with this calculator here, and then you can do some modeling and see how that pans out for you. Now, if all these things that I keyed in here were to hold true, then after 10 years, my invested amount of $1,500 would be worth approximately $7,474 for a total return of 176%. But of course, I would have to pay taxes on that. Now, what are the advantages for the investor? So a couple of advantages here is, firstly, you're accumulating more shares, basically at zero commission because you're not doing a trade. And very frequently, these dividend reinvestment program shares are issued to you out of treasury. So it's not an open market buy. So there's no commission payable on any of those. And then, of course, you're benefiting from cost basis averaging. So as the stock price goes up, you are actually buying less shares when you receive your dividends. But on the other hand, if the stock price goes down, you are actually purchasing more shares at a lower price. So even though it might be a fractional cost-based adjustment, if the stock price is lower, your cost basis is going slightly lower. And if the stock price is higher than your existing cost basis, it's going to average out for a little bit. So you are averaging over time. And especially if you do it over a longer period, like 5 years, 10 years, or whatever, there is a significant benefit in terms of averaging out your cost basis as you go along. Investors can also buy fractional shares, which means every dividend dollar is put to work. And what that means is simply this. If Sibanye is trading at $15 and your dividend is $16.50, they don't buy one share and that leaves them $1.50. They actually buy one share and the rest is applied to a fraction, which means 100% of your dividend is actually put to work. The biggest advantage by far is compounding. And if you are not familiar with compounding, then that's a subject that you certainly want to study, especially if you're getting into investing in for the first time, and you have a long-term horizon ahead of you. So if you are younger, like especially if you are starting out and you're in your 20s and 30s, you can turn a relatively small investment into a mega investment by just leaving it alone and allowing it to compound, as long as you do some due diligence and you pick really, really good stocks. And there are many ways in which you can sort of get some guidance and assistance and even advice. I don't offer advice, but you can even get advice from smart people in terms of what you should be invested in over the longer term if you just want to watch your investment grow and grow and grow. But hey, the advantages are not only for the investor, they are also advantages for the company, because dividend issuers always benefit from drips as well. And the reason why they benefit, so the entity that issues the equity is called an issuer. And the reason why they also benefit is because a drip creates more capital for the company to employ, because instead of paying out cash, they're actually paying out stock, and then thereby they can use that cash in order to grow their own business and grow the company. In addition to that, just philosophically, shareholders who participate in a drip program are far less likely to sell their shares when the market declines. In fact, when the market declines, as I said a minute ago, shares actually cost you less. So if you are receiving dividends and the cash dividend is X and the stock price has gone down, you are simply buying more shares with X than what you would have bought compared to with when the stock price went up. So guys, that's kind of like a quick sort of overview in terms of what it looks like. But let's take a look here at what it looks like sort of on paper if you work with me in this particular example. If we say a company pays dividends of 6 to 8% per year, and remember I said Sibanye pays more than 10 currently in terms of its percentage yield, and you get a stock appreciation of just 6 to 7%, which is realistic. Over more than 100 years, the Dow, the industrial index of 30 major companies has averaged growth of about 6 to 7% for more than 100 years. So that's a reasonably realistic expectation. Plus that dividend, if you were to reinvest it, obviously is a healthy percentage of reinvested cash. Look at the difference here over a period. So this is showing you a 15-year hold period. Without a drip, your investment would have been worth, if it were $10,000 at the beginning, $42,000, which is a great return on investment over a 15-year period. But if you reinvested your dividends, assuming that you were paid a dividend as well, it would be worth over $100,000. Now, if you put that into perspective, if you started doing this when you were 25, by the time you actually hit 40, and I know it sounds like it's forever and it's a long, long way away, it doesn't matter. Start socking away some money early and reinvest the dividends if you can live without having to draw any of that cash. Make regular contributions and you'll see your wealth grow exponentially over time. And there's a massive difference between not reinvesting your dividends and reinvesting your dividends. So this is basically a short overview. It's an educational video. And if you're still with me right now, then I appreciate the fact that you stayed with me until the end. And if you like the content, of course, please subscribe. If you have any comments, comment and let me know what you think. And of course, if you're an old pro, you know all this stuff already. So there's probably nothing that I've just told you that you haven't heard before. But as I said at the beginning, this is not about undervalued stock. This is about major stocks that pay big, big dividends and that can make you fabulously wealthy over an extended period of time. As long as you're patient and you pick smart, doing your homework, you pick smart investments and you invest in equities that are going to deliver good growth, solid growth over time, in addition to a very healthy dividend. So I hope that works for you. I hope this is beneficial to somebody anyway. And on that note, this is Mr. Oxy saying thanks for watching. Bye-bye.